Okay, folks, welcome to Volume 4 of the continuing series, the Inner Circle Traders Market Maker Collection. This is Volume 4 of 12 installments in the continuing series. And this particular volume was going to focus specifically on advanced institutional order block and market structure analysis. Now, I've, I've released an idea on how I interpret the market and its market structure over the last 2 decades as it relates to the commodity market, currency market, and now spot FX. And because of my exposure to the institutional aspect of trading, I was able to glean a lot of insights that isn't readily available to the retail universe. Now, uh, before I get into this, I want you to understand very clearly that it's not essential that you understand this to be profitable. Okay, what this does is gives us a behind the curtain view, as it were, to why the markets are doing what they're doing. And for those that have an insatiable need for needing to know why something works, and because of my obsessive compulsive disorder as a human being, I had to know that myself. So going forward in your trading, if you aren't at that stage now, okay, and you're profitable, um, out of sheer morbid curiosity, one day it might just, you know, prod you to, investigate, if you will, why certain market truisms are what they are. Why do markets take on a persona of retracing into previous structure, order blocks, and why do they react as they do in your charts? And by understanding the mechanics of the institutional side of how orders are placed on large scale entities like banks and large institutions, you'll understand very clearly why the markets ebb and flow higher and lower, where they retrace to, where they expand to, and then pause. All of those characteristics will become clear to you once you do an in-depth study of what price action has done on the left side of your chart. You'll have a greater understanding of what's to come on the right side that's unknown. Okay, and a lot of the study that we will be encouraging in this volume and in volume 5 will be on a hindsight basis. Now, I know a lot of folks are um, uncomfortable with the word hindsight, but you have to understand you can't arrive at a greater understanding of something until you have seen it over a period of time, exposure repetitively. Okay, and what it does is it trains your eye to see the characteristics that are inherently generic to this repeating phenomenon. Now, the phenomenon I'm referring to is the order block specifically. Now, it's not enough just looking for a down candle to buy into and an up candle to sell into. There's got to be some framework around those ideas. Otherwise, it's simply just, it's chaos, and you're just going to be in there frustrated because you're looking for something that doesn't exist. Okay. So, also, let me toss this out there. I want you to be aware that I am cognizant of the truth that just simply looking at the charts on the left side in great detail, in hindsight. Okay, for instance, if you study the market in back data, looking at going over old price swings and such, say you do it for 2 or 3 years worth of data. Okay, I am not going to sell you the idea that's the equivalent of having 2 to 3 years experience. Okay, that's perpetuated by the retail universe. Okay, what it does is it just builds a familiarity to a concept. It does not give you experience. The experience will come from you trading on the right side of the chart in unknown data. That's where the real learning comes from. Do not be lulled into believing just simply because you're scrolling back through old data that all of a sudden now trading is going to be easy for you. Okay, or so-called advanced pattern recognition trading or harmonic trading is going to be easy for you because of that. No, it's not. The learning, you haven't even began yet, because it has to happen from the right side of the chart. And that's what my video series, this one and all the ones prior to it, have been really trying to uh, perpetuate in you, is the understanding of the expectancy of your learning is not going to come from what I show you in examples. It's going to come from your exposure of what happens on the right side of your chart going forward. Okay, those are the life lessons as a trader that no mentor can share with you. We can't do that. Okay, my mentors couldn't do it with me, and I'm telling you, I'm not going to be the one that does it either. Okay, so there's a learning curve that each of us have to endure, and some of it's going to be quicker than others, and some other things will be a struggle. But if you do not give up and you maintain a steady forward momentum in terms of just plowing through the data, plowing through the exercises of getting used to seeing it, understanding time of day, day of week, time of year, seasonality, and understanding the large flows based on COT influences and commercial traders, that will all synergize into a greater understanding, and you'll see when it is specifically that you want to be doing your trading. I can't force you into this is how it's going to be every single time, because there's going to be minor variations and deviations from the overall ideas that I'm sharing in this particular series, because we are looking at the concept of institutional order blocks. There has to be a understanding that there still remains a gray area. It's not black and white yet. Okay, black and white comes from you doing your trade and exiting the trade, and the final results are what they are, black and white. Okay, while we are trading, we're always in that gray. We can't get out of the uncertainty of whether or not the trade is going to be uh, as we expected prior to hitting the enter. Okay, so I put all that out there to understand. I understand that you are expecting specifics in terms of exactly this, exactly that, and it's always going to look like that. Okay, um, it's not going to be like that. There's going to be some minor deviations, but when you understand what's going on behind the scenes and why institutional orders should be, flooding the market, and when they should be scaling out of those trades, then you'll have a greater understanding of what order blocks are going to be good, what order blocks should be avoided, which are low odds or expectancy in terms of profitability, and which ones are high odds of being profitable if traded. Okay, and that's really what we're going to try to be focusing on specifically in this module. And then we're also going to be dealing with when we're wrong, how that is still advantageous to you as a trader, and not to be fearful of taking the next trade based on your failed order block. Okay, and when we talk about mitigation, not only will we be mitigating our own losses in volume 5 of this series, but we'll also learn how large institutions inject um, liquidity in the marketplace, and we're going to be hinting at some of those ideas in this module here as well. But more specifically, we're going to be looking at qualifying and quantifying solid, uh, very trustworthy order blocks in your trading. All right, the ICT institutional order blocks. Now, order blocks are specific candles or bars that, when properly viewed in institutional context, they can highlight smart money buying and selling. Now, if you have been studying price action of any length of time, there has been this movement, if you will, that's dubbed a supply and demand. Now, while I agree there are certain aspects to the market influences, okay, that we see in price action that are governed by supply and demand factors, that we honestly, I believe, and I 100% subscribe to the idea that we as individual traders cannot arrive at the fundamentals on the level that the institutions do on a day-by-day basis. Now, we can have a long-term macro view on that, and that's very advantageous to our trade.